Let's touch base with Omar Negyal, get you some more perspective on how foreign institutions are really viewing India right now. He's a key fund manager at HSBC Global Asset Management, joins us on the show right now. Omar, it's good to have you on the show. Has your view on India changed over the last 3 months? What's the view on India now with the GDP estimates for FY13 indicating sub 7% growth? Do you think the second half of this year could mean a rally for India or consolidation with a downward bias?
Well, at the start of the year on our emerging markets funds, we actually changed our allocation to India and moved it from an underweight position to an overweight position. So we were buying stocks in the market. And we've held that view consistently through the rest of the year. Today, we continue to have that view. We can see some cheap stocks in the market. And what we're really interested in is not the GDP level of the economy, but whether we can find good companies which generate decent returns on capital and which we can access at good valuations. And we see enough of that today to be overweight the Indian market.
Omar, how do you tie in the world situation today and the impact as to whatever the macro developments lead out to be could have on the emerging market equities in the second half of 2012? Are you optimistic or cautious on emerging market equities?
There are obviously a lot of risks out there today. I think that the two big picture ones are Europe, where we can continue to see a lot of disagreement over how policymakers are going to react to what's happening there. And I think it's fair to say that if we don't see an improvement in Europe, it's going to be hard for emerging markets to perform well in the short term. The other key area is China. And again, there's a lot of worry in the market over where the trajectory of the economy is heading, whether we're heading to a hard landing in China. And here our view is much more constructive. So we see a fiscal and monetary easing coming through for that market, and that leads us to be a little bit more optimistic than the rest of the market. So overall, that leads us to be reasonably constructive on emerging markets today. We see emerging markets trading at a valuation level which is a discount to history. So today we can buy emerging markets overall at around 1.5 times book value. To us, that gives us a good margin of safety. And that valuation level is a key reason for us to be positive on emerging markets today.
Right, Omar, you also run a long-short EM equity fund. Are trades there more on the short side for most markets? How are you positioning yourself for intermediate rallies that we see on a day-on-day basis, just like yesterday?
For our long-short fund, this is generally a low net exposure fund. So we're running net exposure between minus 20% and plus 20% in general. Actually, what we've been doing over the last month or so is to slowly increase the net exposure of the fund. And today we're sitting at more on the long side, so we have a long exposure in the fund. And again, that ties into what I was saying about valuations in emerging markets. We see valuations in emerging markets as more attractive today, and we want to position a long-short fund to take advantage of that.
Omar, you would have watched earnings carefully in India. We've just ended the season a couple of weeks ago. How have the overall weightages changed on sectors post the earnings? And are there any clear overweights or underweights post this earnings season?
We do have some clear sector views within India. Today we're overweight in energy, materials, financials and consumer discretionary. And on the underweight side, we're underweighting the technology side as well as consumer staples.
Okay, Omar, what's your view between private banks versus PSU banks? Since you are saying that you're looking at building your positions in financials.
Today we're much more in favour of the public sector banks, and that's really a valuation call. I think it's fair to say that most people would agree private sector banks do offer generally higher quality, but the fact is today we can buy public sector banks at valuations significantly below book value, and to us that's compelling enough to be attractive despite the worries over some of the asset quality issues on that side.
Very quick one, Omar. What about autos between four-wheelers and two-wheelers? What's your preference?
Here our preference is for the four-wheeler area, although I think we're being very, very selective in terms of the names that we're interested in. For two-wheelers, we do see this area as offering high returns on equity, which is attractive, but we just think the valuation levels aren't particularly compelling enough for us to get involved at these prices.
There's been much talk about how the oil and gas sector in India perhaps could see some more re-rating, especially post the petrol prices being hiked. Are you looking at the downstream companies in India, oil retailers, or is your favor and preference more towards the upstream?
We do like the oil and gas sector in India, but we're particularly interested in the upstream areas. So for us, it's that profitability from upstream oil and gas which is driving our view on those companies. Clearly, the petrol price hike is helpful because it means that upstream profitability is not being dragged down by subsidies to the downstream. I think if we saw more of that, it would be a positive.
Last but not the least, Omar, I was just wondering if the rupee fall has really led you to become bullish on the export sectors, IT and pharma.
We're actually underweight those two areas, despite the move in the rupee. We think there are some very good companies in that area, but our view is we want to buy these companies at attractive valuations. And today we don't see the entry points for either technology or pharmaceuticals.